Good evening, everyone. Time for another silver update. This is the 15-minute chart, 10-day from bigcharts.com, the 10-day graph of facebook.com. I'm going to call this one FleeceBook, and you'll see why in a little bit when I delve very deeply, a fairly long reading, and there's a reason for that, in Jesse Livermore Reminiscences of a Stock Operator, because most people don't know, but the first half of Livermore's career was, people are very familiar with that. He was a bucket shop trader who became a big Wall Street plunger, is the only term at that time. But actually later in his career he became what today would be known as perhaps a venture capitalist, and he was involved with the venture capitalists of his day, and he actually probably was the king of the IPO of his day. Most people don't know that, but we're going to read this section on that. But before, I wanted to take a look here at FleeceBook stock, and I've pulled up some indicators here. The top indicator is the volume, the second indicator is the on balance volume, and the third indicator is the money flow. Now you can see that the volume, you have to remember, we're going to look at some Yahoo key statistics to look at. This is a 2 billion shares, and that's going to be really interesting when we look at that. But so you can see the volume here. We're only trading maybe 5 million, 10, gets above 10 here, 15. It's a billion float, so not a lot of stock. And you can see if the on balance volume and money flow are any indicators, it's all selling. So, and you can see it looks to be all selling. So now I'm going to go to Jesse Livermore to show you why it's so important to understand what type of market you're in. And clearly the bloom is off the rose with the IPO market that FleeceBook, I should say, basically stepped into. But we're going to take a look at the key statistics before we get over to Livermore, because I want to make a point about this float. So if we go over to Facebook on Yahoo and look at the key statistics, you can see we're down to 27.72. I think it traded as high as 45 at one point. We can look at the summary and see that. Yeah, 52-week range is 45, so we hit 26.83. So this one's going to be cut in half pretty quick. And I think we had originally a $100 billion market cap, and we're here at a $60 billion cap on this stock. Now, but here's what I want to point out that's really interesting is the float. And let's look first at the revenue. 4 billion, I don't know what that's made of. Advertising maybe? I'm not really sure. You can see the gross profit is not available. Earnings before interest, taxes, etc. is 2 billion. So, but these are kind of shaky. We don't really know what the numbers are as far as that. But it's a 60 billion market cap. You can see the shares outstanding are 2 billion and the float is a billion. So keep that 2 billion in mind when I show you. I'm going to start off with Cisco Systems. This is one of the famous stocks from the 90s and 2000s. And if we look at the statistics, you can see it's an $85 billion market cap, so not that much higher than Facebook, actually lower than the initial offering price market cap of around $100 billion. Anybody who knows anything about Cisco knows that this is a company that pretty much has built the backbone of the internet. So, I mean, if you look at the key statistics here, you can see the amount of revenues that they generate. They're like Microsoft. You can see there's $45 billion in revenues. So this is a real company with real earnings, and they're not much higher than Facebook in market cap. Now the other thing that's really interesting, we're actually going to look at Microsoft as well, but I wanted you to look at this 5 billion shares outstanding. The float is 5 billion. If you remember, the float on Facebook was 1 billion and 2 billion shares outstanding. Now you may say, okay, well, that's twice as big as Facebook. But we want to look at the history of how we got here to see how far and how badly they misjudged. And misjudgment in that type of venture is going to be something we're going to learn from Jesse Livermore. But let's take a look at the chart here real quick. We'll go to the summary and then pull up the long-term chart. And I want to show you something on this with the splits. Now, I've marked the splits here, and I'm going to go through the math on this one, but not on the next one. But if you look at the splits here, you can see if we deduce backward, and I've already done the math here. If we assume, based on these splits, let's say that when Cisco initially came out, they had their float was 30 million. So if we do that, we do the math, they went to 60 million, 2 for 1 would be 120 million, 2 for 1, 240 million, another 2 for 1, 480 million. There's a 2 for 1, that's, we'll call that a billion. A 3 for 2, that's 1.5 billion. Another 3 for 2, that's 2.25 billion. 2 for 1, that's 4.5 billion. Another 2 for 1, so that's 8 billion. So they actually had less than 30 million shares. Now if we go to Microsoft stock, we can do the same thing and pull up the big chart. And if we do the math on them, so Cisco was probably around 20 million. If you do 25 million and do the math here, it comes about to the 8 billion that Microsoft's currently at. So that's a very interesting point to point out here. These are real companies making real things that were the wonder stories of their time. Yet when Microsoft came out, it only had 20 million shares. When Cisco came out, it only had about 20 million shares. If we do the math backwards, that's the entire float of that company. While we've got Facebook, or FleeceBook, I should say, IPOing. And remember, this is a company that doesn't make anything. And this company is IPOing. They're coming out. They're starting out with a 2 billion shares outstanding. So that is insane. And so let's go over to Livermore, because I want you to understand the concept of how the bloom can be off the rose for a market. Because when you're trying to market stock to the public, and that's what it's about fleecing the public. If you're not doing it in the right environment, you're simply not going to succeed. So let's jump over to Livermore, and he's finishing up with his marketing of Imperial Steel, and then he's going to get into this stock called Pete's Products, and you'll see as we go through the story what I'm talking about, the bloom being off the rose. So Livermore says, there wasn't anything about my manipulation of Imperial Steel that wasn't normal and sound. As long as the price went up on my buying, I knew I was okay. The stock never got waterlogged, as a stock sometimes does. When you find that it fails to respond adequately to your buying, you don't need any better tip to sell. You know that if there is any value to a stock and general market conditions are right, you can always nurse it back after a decline, no matter if it's 20 points. But I never had anything like that in Imperial Steel. In my manipulation of stocks, I never lose sight of basic trading principles. Perhaps you wonder why I repeat this, or why I keep harping on the fact that I never argue with the tape or lose my temper at the market because of its behavior. You would think, wouldn't you, that shrewd men who have made millions in their own businesses and in addition have successfully operated in Wall Street at times would realize the wisdom of playing the game dispassionately. Well, you would be surprised at the frequency with which some of our most successful promoters behave like peevish women because the market does not act the way they wish it to act. They seem to take it as a personal slight, and they proceed to lose money by first losing their temper. There has been much gossip about a disagreement between John Prentice and myself. People have been led to expect a dramatic narrative of a stock market deal that went wrong, or some double crossing that cost me or him millions, or something of that sort. Well, it wasn't. Prentice and I had been friendly for years. He had given me at various times information that I was able to utilize profitably, and I had given him advice which he may or may not have followed. If he did, he saved money. He was largely instrumental in the organization and promotion of the Petroleum Products Company. After a more or less successful market debut, general conditions changed for the worse, and the new stock did not fare as well as Prentice and his associates had hoped. When basic conditions took a turn for the better, Prentice formed a pool and began operations in Pete's products. I cannot tell you anything about his technique. He didn't tell me how he worked and I didn't ask him, but it was plain that notwithstanding his Wall Street experience and his undoubted cleverness, whatever it was he did proved of little value, and it didn't take the pool long to find out that they couldn't get rid of much stock. He must have tried everything he knew, because a pool manager does not ask to be superseded by an outsider unless he feels unequal to the task, and that is the last thing the average man likes to admit. At all events, he came to me, and after some friendly preliminaries, he said he wanted me to take charge of the market for Pete Products and dispose of the pool's holdings, which amounted to a little over 100,000 shares. The stock was selling at 102 to 103. The thing looked dubious to me, and I declined his proposition with thanks, but he insisted that I accept. He put it on personal grounds, so that in the end I consented. I constitutionally dislike to identify myself with enterprises in the success of which I cannot feel confidence, but I also think a man owes something to his friends and acquaintances. I said I'd do my best, but I told him I did not feel very cocky about it, and I enumerated the adverse factors that I would have to contend with. But all Prentice said to that was that he wasn't asking me to guarantee millions in profits to the pool. He was sure that if I took hold, I'd make out well enough to satisfy any reasonable being. Well, there I was, engaged in doing something against my own judgment. I found, as I feared, a pretty tough state of affairs, due in great measure to Prentice's own mistakes while he was manipulating the stock for the account of the pool. But the chief factor against me was time. I was convinced that we were rapidly approaching the end of a bull swing, and therefore that the improvement in the market which had so encouraged Prentice would prove merely a short-lived rally. I feared that the market would turn definitely bearish before I could accomplish much with Pete Products. However, I had given my promise, and I decided to work as hard as I knew how. I started to put up the price. I had moderate success. I think I ran it up to, it doesn't say, or thereabouts, which was pretty fair, and I was even able to sell a little stock on balance. It wasn't much, but I was glad not to have increased the pool's holdings. There were a lot of people not in the pool who were just waiting for a small rise to dump their stock, and I was a godsend to them. Had general conditions been better, I also would have done better. It was too bad that I wasn't called in earlier. All I could do now, I felt, was to get out with as little loss as possible to the pool. I sent for Prentice and I told him my views, but he started to object. I then explained to him why I took the position I did. I said, Prentice, I can feel very plainly the pulse of the market. There's no follow-up in your stock. It is no trick to see just what the public's reaction is to my manipulation. Listen, when Pete's Products is made attractive to traders as possible, and you give it all the support it's needed at all times, and notwithstanding all that you find is that the public leaves it alone, you may be sure that there is something wrong, not with the stock, but with the market. There's absolutely no use in trying to force matters. You're bound to lose if you do. A pool manager should be willing to buy his own stock when he has company, but when he is the only buyer in the market, he'd be an ass to buy it. For every 5,000 shares I buy, the public ought to be willing or able to buy 5,000 more. But I certainly am not going to do all the buying. If I did, all I would succeed in doing would be to get soaked with a lot of long stock that I don't want. There's only one thing to do, and that is to sell. And the only way to sell is to sell. You mean sell for what you can get? Asked Prentice. Right, I said. I could see he was getting ready to object. If I'm to sell the pool stock at all, you can make up your mind that the price is going to break through par, and by the way, par is 100. "Oh no, never," he yelled. "You'd have imagined I was asking him to join a suicide club. Prentice," I said to him, "it is a cardinal principle of stock manipulation to put up a stock in order to sell it, but you don't sell in bulk on the advance. You can't. The big selling is done on the way down, from the top. I cannot put up your stock to 125 or 130. I'd like to, but it can't be done. So you'll have to begin your selling from this level. In my opinion, all stocks are going down, and petroleum products isn't going to be the one exception. It is better for it to go down now on the pool selling than for it to break next month on selling by someone else. It will go down anyhow." I can't see that I said anything harrowing, but you could have heard his howls in China. He simply wouldn't listen to such a thing. It would never do. It would play the dickens with the stock's record, to say nothing of the inconvenient possibilities at the banks where the stock was held as collateral on loans and so on. I told him again that in my judgment, nothing in the world could prevent Pete's products from breaking 15 or 20 points because the entire market was headed that way, and I once more said it was absurd to expect his stock to be a dazzling exception. But again, my talk went for nothing. He insisted that I support the stock. Here was a shrewd businessman, one of the most successful promoters of the day, who had made millions in Wall Street deals and knew much more than the average man about the game of speculation, actually insisting on supporting a stock in an incipient bear market. It was his stock, to be sure, but it was nevertheless bad business. So much so that it went against the grain, and I again began to argue with him, but it was of no use. He insisted on putting in supporting orders. Of course, when the general market got weak and the decline began in earnest, Pete Products went with the rest. Instead of selling, I actually bought stock for the insiders pool by Prentice orders. The only explanation is that Prentice did not believe the bear market was right on top of us. I myself was confident that the bull market was over. I had verified my first surmise by tests, not alone in Pete's Products, but in other stocks as well. I didn't wait for the bear market to announce its safe arrival before I started selling. Of course, I didn't sell a share of Pete Products, though I was short of other stocks. The Pete Products pool, as I expected, was hung up with all they held to begin with, and with all they had to take in their futile effort to hold up the price. In the end, they did liquidate, but at much lower figures than they would have got if Prentice had let me sell when and as I wished. It could not be otherwise, but Prentice still thinks he was right, or says he does. I understand he says the reason I gave him the advice I did was that I was short of other stocks and the general market was going up. It implies, of course, that the break in Pete Products that would have resulted from selling out of the pool's holdings at any price would have helped my bear positions in other stocks. That is all Tommy rot. I was not bearish because I was short of stocks. I was bearish because that was the way I sized up the situation, and I sold stocks short only after I turned bearish. There's never much money in doing things wrong and two, not in the stock market. My plan for selling the pool stock was based on what the experience of 20 years told me alone was feasible and therefore wise. Prentice ought to have been enough of a trader to see it as plainly as I did. It was too late to try to do anything else. I suppose Prentice shares the delusion of thousands of outsiders who think a manipulator can do anything. He can't. The biggest thing Keene did was his manipulation of U.S. Steel Common and Preferred in the spring of this year. He succeeded not because he was clever and resourceful and not because he had a syndicate of the richest men in the country in back of him. He succeeded partly because of those reasons, but chiefly because the general market was right and the public state of mind was right. It isn't good business for a man to act against the teachings of experience and against common sense, but the suckers in Wall Street are not all outsiders. Prentice grievous against me is what I've just told you. He feels sore because I did my manipulation not as I wanted to, but as he asked me to. And he goes on and on. It's just unbelievably timeless wisdom. But you can see there with the marketing of that stock that Livermore knew that the bloom was off the rose with the bull market. Now, with this FleeceBook stock, it's very clear from the action in this stock And with the unbelievable greed of putting 1 billion to 2 billion share float out for a company that really doesn't even have anything to sell, that these are worse than Prentice times 100-fold in their foolishness. The only thing that I guess is not as foolish as Prentice is apparently they didn't form a pool to buy up this stock and put the price high. It probably was put high at the IPO, way too high. So the bloom is off the rose of the stock market. I think if we pull up a Netdania chart, and I'll put a link below to that. If we pull up a Netdania chart of the stock market in general, we're probably looking at an incipient bear market, very similar to what Livermore was looking at when he was forced to, if you remember, when he was asked if he wanted to market, and that's in his day was similar to what the IPOing is today. If you look at the chart here of the Dow, you can see it appears that we're in an incipient bear market here, and that Facebook could not have picked a worse time to try to market this elephant of an IPO. Now, if they would have marketed this thing down here or even here, they probably maybe not could have unloaded at higher prices all of those shares. They certainly could have unloaded a lot of shares. But now it appears that Facebook or FleeceBook is faced with the proposition of just unloading their shares in a falling market, and they'll probably fall 90% to a fraction of their value just because of the incredible greed of the people trying to unload their shares on the public. So you can see nothing has changed in over 100 years. The Wall Street operates in the exact same way, and Livermore is just a confirmation of that. So we'll keep an eye on Facebook and see where it goes. They've obviously overestimated their ability to unload this stock on the public, and we'll talk to you next time.